quarterly GDP growth, that's gross domestic product for Nigeria, 4.2% on an annualized basis in the second quarter of 2025. Numbers, of course, from the Bureau of Statistics. We've got 2 arrows there showing when the administration took office in the second quarter of 2023. And as you can hear, the rain is back. And then the arrows to the right is the rebasing in the first quarter of this year, so 3.13% there. So fastest growth since what, 2021, second quarter, I think. Let's jump in. Let's dive in. We're happy to have Damilare Asimiyu, who's a macroeconomic strategist, AfriInvest Research and Consulting. Damilare, it's great to have you. Last time we had you had that awesome insurance report, which we continue to reference as we continue to talk about insurance here. What's your reaction to these GDP figures for the second quarter?
Thank you for having me on the show, Otis. Good morning. Well, there is a saying that you're as good as your last performance.
Yeah.
And if the latest GDP number is anything to go by, over the last decade, we have not had GDP growth cross 4%. The last time we had GDP of 4% was first quarter of 2015. That shows you how long the economy has been struggling to pull up its weight. Yeah. So with a 4.23% growth in Q2 2024, I mean, the best assessment you can give to that number is that the economy is beginning to show some signs of better prospect. We are not there yet because, like I've always emphasized, if you look at the parameters and what we Nigeria need to do to grow at a level that will have inclusive impact on the economy, even going by the basic notion of Okun's law, we need to do double fold of our GDP before, of our population growth before the growth to be seen as strong and ready enough to lift the population. And with our population growth of roughly about 2.6%, definitely the baseline growth we should be thinking around will be about 5%. But at 4.2 is better than where we are because it took us more than a decade to pull this kind of weight. So basically, it's an encouraging and an impressive GDP number.
I want to talk about oil. And I guess looking at the efforts to try to grow oil production, what you make of the oil sector is growth in our oil production and so on. So what's your thoughts on how we did in oil?
I mean, looking at the number itself, the oil GDP grew about 20% in Q2. Yeah. I mean, that is remarkable. And just like we always advocate, right, for you to see solid numbers in the oil sector, 2 things have to work together. Number one is that you have to create that enabling environment for private sectors to thrive. You also have to ensure there's security on your hand. The other hand, you don't have direct control over, which is the price. Now, what drove this remarkable growth in the oil sector is the fact that production was a bit stable and it's increasing at a very mild rate. I mean, at the beginning of this year, both crude and condensate reached about 1.7 million barrels per day. February, March, it began to fall. Then after some reshuffling, the NNPC and also the government tightening security conditions, we began to also see improvement from May. And the last number that was out in July, we saw that we also reached that January level of 1.7 plus million barrels plus condensate. So it does mean we have healthy crude production. The crude production there alone was more than 1.5 million barrels per day, which is our OPEC quota. Yeah. Now, if you then combine that one with the fact that September last year was when Dangote began to sell PMS to Nigeria, I think the capacity utilization that time was around 25%, just testing the waters. And between then and now, Dangote is doing more about 60-70% of capacity utilization. So it's pumping more oil locally, and that is helping us. So that private sector investment through Dangote, the pumping of more oil, this exports, the better production. We also have a lot of local players that are also expanding their capacity. Talk of Aradel, the acquisitions for some of the MNO. So these are the things that are fueling the oil sector. So basically, the improved political will to secure oil assets, to reduce theft, and also, which also was supportive of private sector investment, is what is telling on the oil sector GDP. And we hope that we can keep up to this because this oil performance is tied to our GDP, to our budget, and of course to the GDP. Our budget benchmark for oil this is 2.0 million barrels per day. We are still not close to it, but we are better than where we are coming from. And the more oil we're able to pump, the more revenue the government will need to get, because for this year, the government is looking at revenue of about 40.9 trillion for the budget. Yeah. And almost 51% of that was to come from oil-related activity. So if the private sectors are not invested, if the environment is not conducive for them, if the oil assets are not saved, we're not going to get this revenue. So it will be a win-win for everyone. If the government plays their part, the private sector will drive the investment.
What would it take to get to 3 million barrels per day? In fact, at one point they wanted to get to 4, but now, I mean, they're looking at least 3 million, I think, by 2030 or so. What's going to...
Yeah, I mean, looking at 3 million barrels per day production at 2030 is realistic, but there are a lot of work to do. You are talking about huge investment, billions of dollars. Rotus, the last time Nigeria's production crossed 2.5 million barrels per day was in 2005. Wow. And if you look at the parameters on ground then, yes, we have pockets of issues around, issues like, not insecurity like this. Then we have issue of MEND, Niger Delta thing. Of course, the government weigh in. At some point, there was amnesty program. But long and short is that the issue of large-scale oil thefts like this, people shipping out oil out of Nigeria without them being apprehended, we're not there. Foreign exchange environment was stable. Insecurity problem was minimal. And a lot of things were working. People were policy direction. People were clear with it. You have a central bank governor. Then we have Professor Soludo. That's right. Who you have clarity of his intention, just like the Cardozo government is doing. And the MNOs were multinational companies. They were pumping investments into Nigeria. So by and large, for Nigeria to actually achieve raising production, which is around 1.7 million barrels per day now, to 3 million barrels per day by 2030, it will require both a structural and physical investment effort. The structural part will have to do with dealing with issue of insecurity. Also, amending some areas in the PRA that are not flexible enough or not clear enough. The issue around host community crisis also needs to be better addressed. Then, with stable FX environment, stable political environment, no chaos, and additional incentives like tax breaks and what have you, you can attract private businesses. Private businesses would like to put their money where they can see the future. The moment they can see their future, they are not coming in. And that is the only thing that can help Nigeria to achieve a 3 million barrel per day in 2030. It is not the government that will do the investment. It is the private sector. But the government needs to create the enabling environment that will attract the private sector to pump in their money.
Fantastic. Let's move to non-oil now. But 3% growth there. What do you make of what we saw in the, 3.4? What's your take on the non-oil sector, the growth we saw there?
So since the rebasing of the GDP, I think even before the rebasing, right, the non-oil sector have been the secret gem for the Nigerian economy, especially the services sector part of it. The services sector did about 3.9%, slightly above what it did in Q2 and better than last year. But the sector or the sector under the non-oil segment that is even more interested this time around is the industries. You see the industry pulling a growth of about 7% in real time, almost double for what it did corresponding period last year. Now, if you then cascade the industry sector down, what really drove that is the oil refining. The oil refining grew 15% plus. And over the last 3 quarters, the oil refining segment under that industry has been growing. And if you look back 3 quarters from now, that is around Q3, Q4 last year, when Dangote began to produce in scale. Before that time, the oil refining segment was in contraction region, meaning that the national refineries were not working. So when Dangote came in and was supplying both locally and internationally, you begin to see the impacts on GDP. And that's why I said it is the private people that actually drive growth in most cases, because when they can see the future of where the money will be, they are ready to pump in their money, and there's a trickle-down effect. So the oil refinery was very key to the performance we are seeing in the industry sector. Now, if you then look at the manufacturing part under the industry sector, growth there is a bit tepid. The manufacturing is still doing about 1.3% growth, which is not good enough, because when you look at the structure of the Nigerian economy, you have the agri, you have the industries under which manufacturing is, and some other things. Then you also have the services sector. The only segment of those three that should absorb more people is the manufacturing, because that's why you can turn to the factory of the world like China. So when your manufacturing is growing at a very weak pace like that, that is not very comfortable enough. And I think with the sort of stability we are seeing in the FX space, inflation also diminishing, I think the manufacturing sector can pick up from Q3, and that will be very good on the overall performance of the economy.
You know, I've always been fascinated at how, when we talk of non-oil, it is oil refining under the industries that contributes to non-oil. I've always found that fascinating. I mean, so technically, yeah, right, you can still count it as contribute, even though it's still oil refining. What about other sectors like agriculture? I mean, we just put up the other highlights there. I mean, agriculture did 2.8, which was higher than last. I think it was in about 1 point something the prior quarter. Or ICT. What do you make about these other sectors or real estates, how they performed?
Okay, let me start from, if you look at the share of the major sector in the Nigerian GDP, trade is the largest contributor to GDP, about 19%, followed by agri and real estate you mentioned.
But trade did like 1 point.
So yeah, that's where I'm going. So if you look at the 3 biggest sectors, right, the first two, which is trade and agri, they are the labor elastic sector.
Right.
If you want to create employment, of course, there's a structural problem with Nigeria, which we may not have time to delve into that. You have an economy where you have the agri sector accounts for about 26-point-something%, and yet you have food insecurity, because Nigeria is one of the countries that has been flagged for food insecurity, that we don't produce enough. When you compare that to most advanced countries, the share of population in agri in most advanced countries, they're less than 5%. Check US data, they're less than 5%. Because one person using the right tools, the right equipment, can actually plant or cover a large expanse of land and create a lot of value. But in Nigeria, we have a large portion of the population. Yes, we are food insecure because we are still using the archaic approach, unmechanized, and we also have problem around logistics, problem around preserving. But that's not the subject here. The subject is that the growth in trade and agri, which should be labor elastic, are very tiny. Both trade had growth less than 2%, agri had less than 5%, which also still reflect the fact that we have problem of production. Insecurity problem is not completely out. Whether the casualty issues we had in Q2 is as high as what we have in Q1 is another debate. So definitely that's a sector we need to focus on as a country, address the structural bottlenecks, insecurity, investment, especially equipment. I mean, about 2 months ago, we saw on the news that the president claimed to receive some tractors. We need those tractors to be deployed. We need fewer of our population to be in agri directly. Why a larger population should be in the agri value chain. When those ones produce, the value chain should improve on it. We should be exporting agri. We should be the food bed of Africa, and perhaps over time to the world. So the growth in that sector is not convincing enough. Real estate did a bit better at 4% plus. But again, if you look at the real estate sector, because of the way the number is structured, you are not able to differentiate the part of it that was driven by private sector and government. But when you look at the budget, right, we still hear from the government that the 2024 capital budget is still being funded. So you are lost 2024 capital budget was supposed to be in the region of about 16 trillion. So if we are still funding 2024 capital budget now, and in 2025 that we have, capital budget is supposed to be about, because our total expenditure is about 55 trillion, 49 point something, the capital component is supposed to be about 23 trillion. That means we have not even started spending those money. So definitely the bulk of the growth in the real estate sector are private sector driven. And so he then reflecting on the fact that the government needs to come in and support those sectors that can employ a lot of people, which will then have trickle-down effect on the broader economy. But the only good thing, one of the good things to take away from this GDP is that, unlike recent quarters, we have more broad-based growth. Out of the 46 activity sectors that make up the GDP, only 3 didn't expand this time around. I think car assembling, other services, and iron ore mining. So having 43 out of 46 sectors expanding is an excellent performance.
Damilare, there's just never enough time. I just love having you on the show to break this. We're out of time. Very quickly, hold or cuts, MPC, what's going to happen today? I
think the MPC have the needed latitude to cut. The parameters are supportive of cuts. Inflation in September came in lower than our own expectation. We projected about 21.3, and they came out about 20. So inflation is, the disinflation trend is stronger. Exchange rate has gained about 3% this year. The reserve is stronger. And when you also look at competitive advantage, you have our neighbors. Egypt has done about 200 basis point cut, Canada 350. And so even if the MPC cut by 100 basis point, our MPR, our market will still be competitive to those ones. And so that means that we'll still be able to attract FPIs, which is one of the fueling power for the stability of the currency.
Damilare Asimiyu, excellent stuff. Macroeconomic strategist, Afro Invest Research and Consulting. Thank you so much for your time.